Good morning. ARMR Insiders, good morning. Welcome to the morning call, September 1st. Terrible ADP jobs number just hit the wire. I don't know why anyone looks at the ADP number. I can't tell you how many times I see that number, and then we get some surprise, strong non-farm payroll number. So it's really hard to get anything from the ADP number. Just word to the wise. I wouldn't read too much into that. So here are my thoughts for this morning. This is day 3 of the risk on green signal from the risk monitor. So we have 2 more days, so today, Thursday, and Friday, to continue to mold the portfolio the way you want to mold it. So what I do on names like today, on days like today, this whole week, is really do a deep dive into the research of the stocks that are in the portfolio. I kind of look at my portfolio like a hockey team, and I'm putting together the line combinations right now. I want to figure out how much capital I want in each group: dividend paying, utilities, financials, precious metals, disruptive growth, and then once I figure that out, I want to make sure that the weakest players are riding the pine, right? I want to get rid of the names that aren't really working and keep focusing the dollars, where I think I really need to be, elevating the best players. So this is what I've been doing the last couple of days, right? We've exited some of the big pharma stocks. Nothing wrong with them. It's just I don't need those names right now, and they're not going to put the puck in the net. Okay, as long as I keep this analogy going, right? So I'm adding things like Twitter and Snap and Amazon, which is having a strong morning. So I'm gearing more for the established growth, disruptive growth type of names that I think would drive the portfolio higher. Listen to the conference call at Airbnb yesterday afternoon, messaging about it. What do you call it in Slack? It's not a tweet. I keep saying tweeting about it, but it's not messaging about it in Slack. And that was just an unbelievable juggernaut of a conference call. That was just an incredible conference call. I mean, you got to listen to that call if you want to hear a story about a company who is absolutely in the crosshairs of explosive growth. I mean, it was just crazy, that story. So thank ARMR Insider Segal for bringing that to my attention. And I know a lot of you have talked about Airbnb, but so when I highlight a particular insider who's brought it to my attention, it's because I get a direct message or something that like forces me to look at it. Okay, and that's exactly what she did yesterday. So I said, okay, all right, I'll go look, I'll go listen. And that was just a killer call. And then I listened to the conference call of Unity. I love the Unity story. I love the chart pattern there. But when you listen to the 2 conference calls, one is very easy to understand, which long term makes it easy. I would expect. Why do I care if it's easy to understand? Because the average investor, the institutional investor, listens to that call, and there are so many parts of that call that just hit all the buzzwords or all of the things that an institutional investor wants to hear. Rapidly expanding margins. I mean, all kinds of stuff. I mean, supply only grows when demand grows. Like their entire supply is demand driven. It's just a crazy story, so I mean, there's so many great things about the story. So when I hear a story that's so clean like that, and I say to myself, you know what? There are institutions out there hearing this story, and it's clean to them too. And that's where guys like to put money. Then I listen to the Unity story. It's a great story, but there's so many moving parts, and they're making acquisitions, and it's not that it's not going to work. And I'm not selling the stock to buy Airbnb. I'm not doing that. I like Unity stock, but I have a tight stop loss on it, right? So if that thing doesn't go and it rolls over, what I would do is take that position out quickly if it fails on that pennant. Let's go look at what I'm talking about. That would be a way, like I'm almost either I want Unity to break out and I'm going to stick with the stock, okay, or it's not going to work here. And I love that pattern. I love the story. Don't get me wrong. It's just It's a great story. It's a great pattern. It's a great breakout. All right. All I'm saying is if it were to roll over and break down, it would tell us this is not right now. And I would easily take that money and swap it into Airbnb. Okay. And they're both basically the same type of chart patterns, right? High profile IPOs. Everybody loved them. Huge run. Then the sell off, right? It's been, more than 6 months of consolidation, which is what I need before I buy something. There's a nice double bottom and a break above the 200-day moving average. And they both did it on explosive earnings numbers. So I want to own both of these names. I hope this doesn't go down. And this looks like a phenomenal story. So don't get me wrong. I shared with you yesterday, listen to these two conference calls and you'll understand when I say to you, God, the CEO's got the bit in his teeth on this thing. They both really do. But this is such a clear story on Airbnb. So I want to find my way into it. I hope Unity works. I have a tight stop on it. And one reason I have the tight stop is when I listen to that story, there's just so many moving parts. They can make another acquisition. They're clearly out there looking to do that. Sometimes that keeps pressure on a stock. So if we see the stock break down from that pennant, if it doesn't break out of this pennant, then it's just not the right time to own Unity and I'll get out of it. Now, if it blows out here, forget what I'm saying. Sky's the limit. And that's why I'm in this. This is such an explosive chart pattern. And I like the overall story. Okay. So what I'll be looking to do today is, again, going over the portfolio, seeing if I need to shave down. I don't know if I need to, if everything goes up in the portfolio and I want to add Airbnb, which is really the only name I want to add. It's the only name left. I'm not going to add Etsy. I'm not going to do Etsy. I'm just, after doing more work on it, it's just not a stock I want to invest in right now. So I could trade Etsy, but I don't want it in the portfolio. If everything goes up, which is a great problem to have, and I want to add Airbnb, what do? Well, I could shave a little bit down of every other position to make room. I might do that. If everything's working, I might just do that. I'm not going to disrupt my financial and utility part of the portfolio. I'm not going to disrupt my dividend part of the portfolio. So, I'm not going to get over my skis in disruptive growth. Right? I'm going to be going balanced. So if I were to add a new position, I might just shave everything down a little bit to just make enough cash to put into one more name. But after that, I'm really done until such time I'm going to end up being in the risk management mode, and until such time that I get stopped out of a position where cash gets created, and then I can go look to see, do I want to put the cash to work or do I want to hold on to the cash, depending on where we are in the market cycle. I'm kind of done forming my portfolio, which is hard to do because we keep listening to conference calls and it gets exciting and I'm missing tons of stuff. I mean, you're always going to miss stuff. It's just part of the job. You make decisions and then you miss something. Like I should have been all over CVS. I talked to you guys about it. Right there at the 50-day, I don't own it. The stock broke out. WBA looks great, right? And it's got a fat dividend, so I could have added that, and I didn't. It broke out. I mean, there's always going to be stuff that frustrates. There's just nothing you could do about it. So you do the best you can, build a portfolio that you like, focus, on the names you want to focus on, and live with the position. This is gapping up today. That's going to be a no-brainer, I think. So anyway, day trading stance. So when you look at Gamma information today, and it's another day of tight trading ranges based on Gamma. So take a look at what the indexes looked like yesterday on our intraday day trading charts. Look how tight they are. I mean, you almost can't see the NASDAQ 100. I have to open up the pattern like this. I have to highlight it and do that just so you can see the trading range. See, the opening range low is the red line and the opening range high is the green line. It never traded outside that range. So when we come into the day with a Gamma information telling us it's another tight trading range, it tells me two things. Number one, there's really no way to make, I mean, there's always a way to make money, but doing what I do and how I trade, there's no way to make money trading indexes. There's just not enough volatility on the day to make any money trading them. When it goes back and forth between the opening range high and low, there's no money to make. So the way I look at it using the ARMR PMP, which is our algorithm here, you're looking at all of these different lines, right? So what I need is expansion. I need the asset that I'm trading to move down to the third or fourth Fibonacci extension from the opening range, and then we get a risk on buy signal, that we can get a 4 to 6 line move. That's what I'm looking for. That's what I use these PMP lines for, okay? I'm looking for a movement far enough away from the mean. I like to mean reversion trade. So I need a movement far enough away from the mean where I can get a risk on trigger using the algo that'll take us back up to and through the mean. So we can cross 4 to 6 lines, at least 3 lines, in order to make a trade. So that's why I always talk about crazy Ivans. I'm looking for the crazy Ivan during the day. I don't really want to make a trade. This morning, the market's going to open higher. I got nothing to do. So I do research on days like that because the market's going to open higher on a tight trading range day, which tells us it should sell off at some point during the day. So there's no way I'm going to chase it. This is not a gap and go day. Gap and go days happen after big OpExes are over and the pin is gone and you get this explosive move and you have 3 or 4 days where you can gap and go. That's not the market we're in right now. So what we're looking at now is this tight trading range. So higher opens lead to sell-offs at some point during the day. And if we get a vicious enough sell-off, all of a sudden we're outside of the volatility. Don't forget when you're reading gamma information about the tightness of a range, they're talking about end of day. So there could be a big move down in the morning, which is a lot bigger than the percentage move they're thinking of, right? Which means if they're right on their gamma information, it's going to go back into that range, right? That's called mean reversion. So they're going to tell you, in other words, let's say they say that there should only be, I'm just throwing numbers out, a 0.1% move, a 0.1% move on the day. And all of a sudden the market's down 1%. And you're going to say, well, they're wrong. It's down 1%. But by the end of the day, it closes even on the day. They're going to say to you, the daily volatility was nothing. The market went nowhere. Intraday, there was a breakdown. And because they were telling you that the gamma information was calling for no movement, that's a great mean reversion setup. You get the breakdown, crazy Ivan for an hour, reversal, trade that because it's going to go right back up to the magnet of gamma and just sit there. So if it goes too far above or too far below, there are trades you can make. If it stays right around there, there's nothing to make. And so from a day trading standpoint, I focus on trying to find individual stocks to trade that might have more gamma explosion, like we hopped on Snap yesterday. Now, Snap happened to be a stock that we were looking to add to the portfolio, so we held on to it. But for those who are just day trading, it was a unbelievably perfect example of a gamma trade, a gamma day trade, which we highlighted before the day started. $75 a share, which was right here. See how it stopped at 75 the day before? Now we're looking at a 3-minute chart, right? So this is Monday's action. Okay, it stopped right at 75, and so we highlighted. Okay, if it goes above 75 this morning, we want to be long Snap, and it blew out above it. We ended up getting long right in here at 75, and then the thing took off. And you could trade it however you want. At the end of the day, as you could see, it came right back to the average true range high of the day and the VWAP, which is totally normal. I mean, so you could day trade it however you want. I would. If I was day trading it, the sale would be right there. That green dot bar that takes you down below the first standard deviation, above the VWAP. That's the exit. So you would carry it right up to there, bang, and you'd be out right there on the move back to the VWAP. Okay? So we'll be looking for trades like that again today. And Twitter's at the top of the list because 65 is the same setup on Twitter as it was on Snap for a day trade. 65 is right here. So it keeps finding resistance at 65. Tried to break above, then pull back below. All right, if it can get above 65, it can get legs. And then if you look over here, we own it in the portfolio now. It's made a higher low, and I put the position on. If it gets above 65, it'll break back above the 50-day moving average, and that could be a real nice spike in Twitter. So that should be at the top of a day trading list if it goes above $65. That's just an example. All right. So those are my thoughts for today. I'll be doing research. I'll be looking to day trade individual stocks. I won't be trading indexes unless they have an outsized move in one direction or another. If the market were to skyrocket up 1% in the morning, I could think about putting puts on the market, right? So now I have a full portfolio. I can start hedging again. We made some good money hedging in the last go round by buying puts on the small cap index. It was easier last time because small caps were so underperforming. Now small caps are catching up. So I wouldn't just buy puts on small caps. It may be small caps and the NASDAQ 100 that I own puts on. But I would only do that if the move gets aggressive, right? So if the market runs up to the ATR high of the day in the first hour, and then puts in a top over an hour and breaks down, maybe I do that for the mean reversion trade, something like that. All right. So those are my thoughts for today. And it's kind of like a lazy day. I mean, we're going to put as much as we can into the Slack room together and share information and ideas, but it's not designed for entertainment purposes. It's designed to make money, right? So if there's just nothing to do, there's nothing to do. We're riding the portfolio. We're making money. We have our portfolio set up. We're doing our research. I'll be sharing research calls. I want to listen to a bunch of calls today. So I'll be putting into the Slack room information on what I think about different companies I'm doing work on. I think Pac asked me to take a look at a couple of names. I'm going to do that today, Pac. And I've got some other names at the top of my list I want to listen to, which I'll share with you if it's worth anything. I think most importantly, Butterfly and QSI, I want to do some research on. So shout out to Chris King on his explanations and discussions about, getting short or writing calls is what he does, I think. I don't know. I don't want to put words in your mouth, Chris, but capturing the downside move on SPACs. These SPACs, to me, at the end of the day, people are going to look back and discover that SPACs were a horrific and terrible way to bring companies public. I wish they never approved them in the SEC. I think it's a joke. And I think it cost investors a ton of money. That type of movement and then collapse and now gapping down because the lockup agreement is over is just really stealing money from investors, and I think it's wrong. So what happens is it gets SPACed, and then there's tons of guys, insiders who own stock, and there's like these lockup agreements that expire, and every time they expire, the stock drops. It's ridiculous until they're, I guess, done selling their stock. And you never really, it's just crazy to me. I don't get it really. So anyway, this thing's going to gap down today because the lockup agreement expired, which is just classic. And kudos to Chris King for collecting, I think, premium on these, these types of calls. It's the short-term holders. Yeah, I just can't stand it. So my question to you, like for instance, Chris, for instance, I really want to own the stock. I want to own Butterfly and I want to own QSI. I just can't figure out when to buy them. I don't want to step in front of another, I know we can go look and figure out the schedule for lockups, but to me, it just caps the stock. I mean, I know like, for instance, on Butterfly, as long as the stock is below 12, they can't dump their shares, and they're locked up for 2 years, as long as it's below 12. Well, what good does that do me? So then the stock goes above 12. What is it? Jumps to 15. They do another deal back down to 12. I mean, it's like, so how do I ever put money in Butterfly when I know at any given time when the stock's trading above 12, they could do another offering? I have to literally sit around and wait for them to do the offering. Let the stock go up. They announce an offering. The stock gets hammered, and I buy it after the offering. That's like the only way I can own this thing. It's kind of frustrating. Suresh, can you please explain in the layman's terms the importance of the information? Vol trigger jumped higher. Volatility trigger jumped higher. It has to do with puts being bought. So when puts are being bought, it's adding hedges underneath the market, right? So one of the best trades in layman's terms, when chatting with Brent, one of his favorite trades is to see the market drop to the put wall or the vol trigger, and then, using whatever triggers we use, we have our own algo, he has his, buying that move. So sell off right down to the vol trigger or the put wall, and then a reversal back above it. So what he's trying to tell you when he says that the vol trigger has gone higher, he's saying that puts are being bought, filling in underneath the market. And so the reason that's important, if the put wall is far away, if volatility is far away, vol trigger's far away, there's an air pocket in the market. Nobody's hedging. So when the market drops below, I think 0 gamma or something, there's nothing to stop it, right? So in layman's terms, put buyers are exposed to decay of their position faster than call buyers, okay? So when the market or the asset drops, put owners tend to sell their puts to book their profit quickly. When they sell their puts, who buys the puts? The majority of those puts are bought by dealers. When the dealer buys the put, he doesn't want to make a bet that the stock is going down. He's trying to make the VIG. He buys the put and buys the underlying stock and matches his position off, so he can't lose money either way. You follow? So when he starts buying the underlying stock, it supports the market. It supports the stock. Does that make sense? So when Brent says this morning that the volatility trigger has moved higher because puts are filling in, it means there's a natural cushion of buyers as the market goes down, which is bullish. This is just probabilities and percentages now, but what that's telling you is there's less of a likelihood that the market will implode. Now, of course, there could be a piece of news that'll crush the market, but on a normal day, there's even more reason to believe in a mean reversion trade, is what he's saying. So if the market drops down to and maybe through vol trigger, and then we get a reversal risk on buy signal using our algo, that would be a great mean reversion trade. Because he's saying that the puts that have been bought, when it drops to that level, those guys will sell those puts. The dealers will buy the put, buy the underlying asset, and push the price up. Hope that helps. I'm just reading what Chris said there on in the Slack room. See, LCID has another lockup in 5 months that expires, and that's when the insiders not pipe can start selling. I mean, why would I ever buy the stock? It's like, what, I have a 5-month window to possibly make some money before more shares get dumped? At some point, cannabis stocks are going to be a steal, and so I keep looking for reasons. I was reading a story about Kushko in Greenland. GNLN, is that the symbol? Yeah, I wonder if that's going to be an idea to put on our whiteboard. Those two companies combined. Yeah, and then Sam says they're going to be, producing a cannabis beverage. Not going to stop that stock from going down, but these stocks are getting incredibly cheap. I mean, at some point in here, we're going to buy the leaps that we bought back here. Remember last year we bought these leaps on Canopy Growth, and we had a huge run. Here we are back into that same range. See, I'm looking for reasons, guys. I'm looking for signs of life in the cannabis space that get me to want to own it. Nothing yet, but it's close. All right, I'm going to get our live trading desk set up. I'll see you guys over there. I guess have a safe trading day out there. All right, make sure you put yourself on the right side of probability when reward's worth the risk. That's the equation. If you're putting a trade on and you don't really think the reward's big enough for the amount of downside risk you got to the stop, then you really shouldn't put the trade on. Okay? And let's all focus on position sizing correctly. Okay, I haven't been doing it right in my day trades. You got to make sure your position size is correct, depending on the type of asset you're trading. Okay, so think about that. That's something I'm working on. All right, guys. I'll see you on the flip.